Okay, good afternoon, distinguished guests, members of the legal community. First of all, I would like to take this opportunity to first thank President Kumar and also the Bar Association of the India for inviting me to speak in this very important conference. The topic today is about issues of overcompliance and also financial exclusion in Global South. So the Financial Action Task Force, we call it FATF, describes financial exclusion as the inability of disadvantaged and vulnerable groups, such as low-income individuals, rural populations, and undocumented persons, to access a sufficient range of safe, convenient, and affordable financial services. These groups are often underserved or entirely excluded from the formal financial sector. Individuals with no income and fewer assets often face limitations in accessing financial institutions. Additionally, women, ethnic minorities, disabled individuals, and immigrants tend to experience exclusion from formal credit markets, leading them to depend on expensive finance providers like pawnbrokers or loan sharks. Financial exclusion is a complex issue arising from various barriers, including high account fees, poverty levels, limited access to digital infrastructure, limited financial literacy, lack of trust, and insufficient or inappropriate financial products offered by the providers. Access to regular financial services such as bank accounts and credit facilities is crucial for economic development and social inclusion, particularly as financial systems continue to erode. From an AML compliance standpoint, de-risking is one of the major drivers for financial institutions in the banking sector. De-risking refers to scenarios when banks and financial institutions withdraw services from certain kinds or sectors to avoid regulatory risk. This can make it difficult for individuals, non-profits, and even small business in the Global South to access basic banking services. Without access to banking, these clients may also struggle to pay for or receive funds for legal services, limiting their ability to seek justice, defend their rights, or comply with legal obligations. Legal professionals may find it harder to represent clients who are de-risked or excluded from the financial system, especially in cross-border matters, international transactions, or cases involving NGOs or voluntary groups. The FATF has started paying closer attention to these issues. It has emphasized the importance of using a risk-based approach to client due diligence more broadly and appropriately. FATF has acknowledged that when the risk-based approach is not applied correctly or proportionality, it can prevent people from accessing basic financial services. To support financial inclusion, FATF encouraged the use of simplified customer checks for low-risk products, such as basic bank accounts with limited features. This makes it easier for people with fewer resources or lower financial literacy to access essential banking services without facing unnecessary barriers. However, the FATF's guidelines on the risk-based approach are open to interpretation, as they leave it up to individual countries and financial institutions to assess and apply the level of risk themselves. This is not an easy task, especially for banks that fear regulatory penalties and fines. As such, AML overcompliance can continue to persist, further limiting access to essential financial services. In the legal sector, we also face similar issues. The FATF's strengthened requirements are imposed on lawyers, even though the profession has been identified as a major conduit for money laundering. This disconnect raises serious questions about the proportionality and the long-term implications for legal practice. While AML measures are intended to prevent illicit activity, they often require lawyers to engage more deeply in clients' personal and financial matters, introducing a level of scrutiny that may affect the traditional dynamics of trust and confidentiality in legal relationship. In Hong Kong, AML compliance presents challenges, particularly for small firms and sole practitioners. These groups often struggle when the capacity of regulations and the resources need to meet compliance requirements. In addition, the legal profession in Hong Kong is under increasing pressure to implement a formal AML supervisory framework, an approach that orders law society's role as a self-regulatory body. This is a complex and sensitive task for the law society to balance. While technological advancements such as regulatory technology have significantly streamlined compliance process, their high cost remains a major barrier. Many local law firms simply cannot afford these solutions, which limits their ability to modernize AML practices. The legal sector continues to face challenges in adopting technology at scale due to financial and infrastructural constraints. In contrast, the financial sector is in a much stronger position. With greater resources and regulatory pressure, financial institutions have been able to invest heavily in advanced compliance technologies, resulting in more robust and efficient AML frameworks. Sharing the Hong Kong experience, I would like to begin by noting that while AML compliance remains important, it is no longer seen as a major barrier to accessing financial services by individuals or business. This shift has been driven largely by the rapid advancement of technology, which has been opened up new channels for service delivery. I'm pleased to share that as of last year, Hong Kong became the second most financially inclusive market globally, according to the 2024 Global Financial Index Inclusion Index. Guess what? Today, in my learned friend Lisa, Singapore literally ranked #1. Public sentiment reflects this progress. 90% of the Hong Kong population now feels financially included, with nearly universal bank account ownership. This achievement stems from strategic investment in digital infrastructure, balanced regulation, and regulatory support for a risk-based approach to compliance. From the digital banking and mobile payment platforms to AI-driven compliance tools and inclusive product design, innovation has become a key enabler, allowing a broader segment of the population to access financial services more easily and securely. This is particularly important for individuals and businesses who face structural barriers to traditional banking, such as low-income individuals, small and medium-sized enterprise, and new startups, who may struggle to provide the documentation typically required to open traditional bank accounts or have wider access to financial services. The Hong Kong Monetary Authority, which oversees banking regulation, has provided clear policy guidance to support this transformation. It consistently reminds banks to apply a risk-based approach to customer due diligence, urging them to avoid unnecessary procedures and reject the use of one-size-fits-all model when assessing account opening applications. This approach helps ensure that compliance does not become a barrier to financial access. A good example of this is the Simple Bank Account initiative. Introduced by banks with the support of the HKMA, the SBAs offer basic banking accounts for companies, which allow banks to apply simplified client due diligence measures under a risk-based approach. Since its launch in 2019, this Simple Bank Account initiative has led to the opening of approximately 13,000 accounts, averaging around 3,000 new accounts per year. This demonstrates the effectiveness of tailored compliance in improving access to banking services for small or lower-risk entities. One of the most transformative developments has been the rise of virtual banks. Hong Kong now has 8 digital-only institutions licensed by the Hong Kong Monetary Authority. They leverage advanced tools such as the algorithmic Know Your Customer, KYC, AI-powered risk assessment, transaction monitoring, and biometric verification. Through the use of electronic KYC systems and a digital government platform such as IAM Smart, residents in Hong Kong, including those in remote areas, can now open bank accounts and conduct transactions without needing to visit a physical branch. These innovations have streamlined client onboarding and significantly reduced operational costs, making it more sustainable for the financial institution to serve a wider range of clients. Another key driver for financial inclusion is fintech. Digital tools like mobile banking, e-wallets, and payment solutions have made financial service more accessible, especially for the individual living in excluded or rural parts. Mobile payments, in particular, have become essential for fast, secure, and inclusive transactions. Today, small business owners and entrepreneurs can apply for loans, manage payments, and access insurance directly through apps without relying on traditional banking. In conclusion, despite technological progress, financial inclusion faces key challenges, such as low financial literacy, access to technology for some jurisdictions, and lack of trust in digital systems. Addressing these issues requires continued investment in education and adaptive and proportionate regulations to ensure technology serves all segments of society. Also, further clarity and guidance regarding AML, counter-terrorist threat requirements, CFT, and the implementation of the risk-based approach for clients classified as high risk is needed. In this regard, the FATF needs to collaborate and coordinate with countries and also different sectors. It is important to incorporate these principles into the FATF's mutual evaluation methodology, ensuring that the implementation of the risk-based approach in line with FATF standards does not exaggerate de-risking. Lastly, the legal profession has a critical role in advocating for a balanced risk-based approach or to AML compliance that protects both the integrity of the financial system and the rights of clients. Lawyers and bar associations can contribute to policy discussions, challenge overboard regulations, and promote guidance that prevents financial exclusion and protects access to justice. Thank you.
Thank you, Mr. Tong.